Thank you. Thank you. Good evening, everyone. My name is Karan Mahesh, and I lead efforts for STR in South and Southeast Asia. Over the next 20 minutes or so, I'm going to be talking about hospitality performance, trends, opportunities. The idea is basically to get aligned on where we stand and what we can expect moving forward. And as always, we're going to start off with a global overview and then come down to a regional, country-level market and then a sub-market context, and then we can see what to expect moving forward. And I'm going to start with global headlines. And whenever we look at headlines, whether you use Google or Perplexity or ChatGPT, there's a lot of uncertainty. And uncertainty can cause confusion, and confusion is, of course, bad. But the real question is, does it really matter? And of course it does, because a lot of our hotel performance is based on these headlines that happen. But instead of looking at headlines, let's look at factual data and cut out all the noise to see exactly what is fact. And I'm going to start by looking at demand growth. Now, globally, demand growth is slowing down, and that is a fact. We've ridden a wave of high demand growth, double-digit demand growth for year-over-year demand for about 2 years to 3 years now. And as of January of 2023, that demand growth was at about 25%. That's now come down to about 1%. But this doesn't mean that everything is disappointing. And for those taking pictures of the slides, you don't need to. There's going to be a QR code at the end of the presentation. You can just scan that, and you'll get the deck. So yes, coming back, demand growth is slowing down, and that's not necessarily something that you need to be disappointed about. We're just slowing down from a sprint to a light jog, but we're still continuing to see growth. From an India perspective, double-clicking and zooming on India as well, that same trend is reflected there. What this slide is showing you is the number or the percentage of hotels that are posting a year-over-year RevPAR decline. And as of July and August 2025, over 50% of all the reporting sample stock that we have in the country are showing a RevPAR decline. And this excludes mid-scale and economy, because we normally see a trickle-down effect from luxury to economy in this country. Another trend we're seeing is something called bifurcation. What does bifurcation really mean? The classes are starting to split apart. So if you look at one way of doing this is looking at luxury hotels and the premium that they're able to get on RevPAR compared to the next class, which is upper upscale. And apart from Australia and Oceania, you can see that all the other sub-regions across the world, the luxury hotels are able to generate a 1.5x RevPAR compared to the upper upscale hotels. And closer home here in Central and South Asia, which is basically India, Sri Lanka, Maldives primarily from a room stock perspective, that difference is 2 times. So we are starting to see that bifurcation happen across the industry. Now, if we look at major global regions or countries within Asia Pacific, you have varying growth across the region. We start off with Vietnam. They're seeing a lot of delayed growth right now. And for the past year or so, and then the foreseeable next 2 or 3 years, we anticipate this growth to continue. And why? Because they've invested a lot in infrastructure. Domestic demand is good. International demand is good. They've eased visa restrictions, and that's all working for the country. Japan, the currency devaluation last year really boosted international demand, but domestic demand is also growing. It's not just Tokyo, Kyoto, or Osaka that are growing, but other regional provinces are growing as well. I'm not going to talk about India because I'll get into that further in the other slides. But a couple of other markets I'll touch upon is the likes of Australia, Malaysia, and New Zealand. Yes, those numbers are low, but that's because they've reached their normal trading levels. They've found maturity. They've stabilized in performance. And last, I'll touch upon Indonesia and Thailand. Both of them are posting negative RevPAR growth this year. It's not been the best of years for a combination of different reasons, mostly political, geopolitical. There was a little bit of a conflict between Thailand and Cambodia as well. There were some abductions in the northeast border that impacted Chinese travel inbound. There's a lot of differences between these two, but both of them are posting negative growth. Now, in this chart, what you're seeing is rolling 12 months of occupancy on the left side and ADR on the right-hand side. And the lines and the colors don't really matter, but what matters is that almost every country has found its normal trading level, and this is a new normal that we're in. Now, of course, you're going to have outliers like Vietnam, like I touched upon, which is the bottom line on the gray on the left-hand side. But one more thing I'd like to draw your attention to is that little circle there. That's about $100 price point. And there's very intense competition there. The bottommost line is India, and it's playing catch-up to the likes of Malaysia, Philippines, Vietnam, etc. And you can clearly see that that $100 price point is very competitive. What happens when price becomes the same is the experience starts to matter. And we'll get into a little bit more about domestic versus international demand, etc. Lastly, from a profitability standpoint as well, yes, our expenses are growing, but it's growing at a lower pace than that of our revenues, and hence we're posting profitability growth. But that pace is also coming down. It's not negative territory yet, but it is coming down. So those were the headlines. And what does reading the headlines give you? Expectations. And what happens when you have expectations? You have the chance of being disappointed. But if you actually look into the data, you can see which side of the bus to be on, and that's exactly what we're going to do from an India perspective now. So in India, we've started to see something called the balance of occupancy and ADR start to shift a little bit. For context, this is blue ADR growth and green occupancy growth, rolling 12 months. Until about January or April of 2023, occupancy growth was outpacing that of ADR growth. But ever since July of 2024, we're starting to see the same thing happen again. Occupancy growth is starting to happen, and we're starting to see more hotels post healthy occupancy gains. What's been working for India is that the balance between supply and demand is positive, and that's helping the industry. In orange, you see supply growth, and that's at a CAGR of between 3.5%, and that's been continuing for the longest time. But what's working is that demand growth is above that of supply growth. And I know Mr. Sethi mentioned this earlier today as well, but I think there's always perspective that matters. And if I focus on a running 3-month and not running 12-month level, you do start to see demand growth decline. And as of July and even August, demand growth is lower than that of supply growth. Yes, there are reasons to everything, and that's exactly what India is. There's always justifications, reasons, rationale, causes, effects, etc. And some of these effects are mentioned here. You had election last year. You had a wedding that entirely lifted up the country's ADR in July last year. Of course, everyone knows who I'm talking about. October and November, you had the Diwali impact and the calendar shift in the months. May this year, you had political instability with the war, and then after that, you had a high base effect in July for last year, which is why you're seeing, including with extended monsoons this year, you're starting to see growth come down. But if we take a step back and look at the typical trading levels of occupancy, and that's what you see in gray there, that's the typical trading level of occupancy, and you start to see the scatter plot of 2023, 24, and 25. Especially in the lean season, despite an extended monsoon, we've managed to push that envelope of occupancy as an industry. And that's what we're seeing reflected in the numbers as well, with hotels posting occupancy gains starting slowly. The one singular standout, however, for India has been rate. And this is exactly how that chart looks for rate. And we've crossed the bandwidth of the past decade way back in 2023, and every year after that, we've been posting rate growth. And that difference is about 30% compared to the upper level of that band. Now, this does not account for inflation or any differences in dollar valuation, but this is in absolute INR. And that rate growth is not just coming across one day of the week, it's across all days of the week. Especially in this year, we're starting to see a lot more corporate demand come back, and that's why you see the Tuesday, Wednesday, and Thursday have a higher pricing power and growth compared to the other days of the week. And that rate growth also is not just across one market or 5 sub-markets. Every single sub-market is growing, and what this is showing you is the count of sub-markets. We track about 49 of them in India. Every single sub-market's growing, and the highest growth is coming at above 6%, with 27 sub-markets posting an above 6% rate growth. So that is definitely diversified. And I've had conversations with many of you in the room, and a lot of you have said, we've not crossed 2008 levels in ADR. But guess what? As of 2023, we have. And that's across every single class of hotels, luxury, upper upscale, all the way to mid-scale and economy. And this is not just unique for India. If I look at Singapore, where I live, or Thailand, which is another market that I handle as well, 2008 was the standout year. Yes, they grew above 2008 levels in 2022, but it took them that long. So we're not way far behind. But what's unique to India is the split or the variance between group rates and transient rates. And I've been speaking about this for about 4 years now, as you can see there. Groups are paying more than a transient guest, and this is a very unique but positive situation to be in India, and I'm going to get to why it's positive as well. But this wasn't the case earlier, because if you looked at the historical group rates, they were always lower than that of transient. And traditional revenue management teaches you that you price groups at a lower price point so that you can then cream the market through transient rates. But that's not the case anymore. Groups are paying higher, and they're willingly doing so as well. And groups are not just across the weekends. Yes, of course, you have weekend groups being the highest in terms of occupancy, but group occupancy on shoulder dates as well as weekdays is very high, and that's not too far behind the weekend occupancy for groups as well. Now, I like to give you this perspective. I'm going to spend about 30 seconds on this slide, where I've segmented India into 3 parts. There's the big 3, which is Bombay, Delhi, Bangalore, highest inventory of supply stock there. Then there's leisure, which is a combination of Goa, Himachal Pradesh, Udaipur, Jodhpur, and Jaipur. And then you have regional sub-markets, primarily tier 2, 3, 4, and 5 cities. We'll start with supply and demand growth. Supply is not grown that much in the big 3 for the year-to-date period. And the good news is that demand growth is outstripping supply growth across all these 3 buckets. And of course, because of that, for the entire country as well. Now, what happens when demand outstrips the pace of growth of supply? You get rate growth. But that's what's interesting here. Rate growth has been the highest in the big 3 cities. That really goes to show how much rate power these cities have compared to leisure destinations or even regional destinations. And regional markets have the highest delta on demand growth over supply, but they managed to grow rates only 2.6%. So that's not very high compared to what the big 3 have managed. Lastly, pipeline as a percentage of existing supply. Leisure markets have the highest amount of pipeline as a percentage of existing supply. Regional markets, from an absolute standpoint, is definitely where every single operator in the room is also willing to expand to, but leisure has that as the highest as a percentage of existing supply. Now, I'm not going to get into specifics of every market here. Many of you in the room know this much better than I do, so I'm not going to spend too much time, but I'll call out 4 or 5 standout points. Number 1, most of your markets are growing. That's good news. Number 2, Bangalore is leading the growth, and someone else mentioned as well, I think it was Raj who mentioned Bangalore as his favorite market, or I think Dimitris. That's definitely reflected in the data as well, where you can see Bangalore post high ADR growth, and that's a clear indicator of corporate demand coming back, international inbound corporate travel also happening, a lot of things working for Bangalore for sure. The next thing is Jaipur. Jaipur is the anchor for leisure destinations, and it used to be perceived as leisure, but no longer, right? You have a lot of groups, you have a lot of MICE demand, you have a lot of weekday business as well as weekends, and a lot of things working for Jaipur. So despite supply growth, there's a lot of demand growth there. Yes, most of this growth is rate-driven, but the last end of the slide is not very positive because leisure is lagging in performance. The last 4 markets you see there are all pure leisure: Jodhpur, Udaipur, Agra, and unfortunately Goa. So I'm going to double-click on Goa a bit because I've been reading a lot in the market, and I'm going to talk about whether this is a correction, a consolidation, or really a crash. And one way of doing this is by looking at something called compression analysis. What do you mean by that? At the bottom, you see occupancy buckets, less than 70% to above 90%, which we call compression. And in green, the number of nights that have posted this occupancy, and in blue, the rate that they've managed. The first thing to note is 2025 has seen 0 compression for Goa. Most of your nights are less than 70%. Yes, we're talking about rate growth declining, but that's not because of bad revenue management. In fact, it's good revenue management because the rates are just reflective of lower occupancies. But more interesting than that is what's the premium that high occupancy dates are able to garner compared to low occupancy dates, and that's 50% for Goa. Higher the occupancy, the highest occupancy above 90%, there's a 50% premium on rate. However, if I compare that to the big 3 markets, that same premium, because of high occupancy in the 80 to 90% bucket, is actually at 70%. So higher occupancy dates are able to gain a 70% premium compared to lower occupancy dates. And it doesn't look that positive from a forward on the books perspective for Goa as well. It's about 3% down for the next 90 days into the future. And I wanted to give you some contrast to other international destinations in Southeast Asia or even Sri Lanka, for example. Goa's rate is not all that low. It is just slightly lower than Phuket, Bali, or Krabi, and this is just for the upper upscale and luxury segments, but it's still higher than Sri Lanka, Hanoi, and Kerala, for example. And Goa is also not very expensive to get to. Air travel is, in fact, the cheapest to go to Goa from any of these markets that you see here on the left-hand side, compared to any of the markets that you see as column headers there. But that's the thing with Southeast Asia. They're eyeing Indian outbound travel, and what's working for them is basically airline capacity. Airlines, not just Southeast Asian airlines, but Indian airlines have grown above 30% to what they used to be before the pandemic as seat capacity into Southeast Asia. And which are the two countries that have seen the highest amount of growth? Vietnam and Indonesia. Both of them have seen exceeding 1,000% growth because your baseline is small, but there's a lot of demand from an air capacity perspective being added there, and they've signed airlift agreements with India, which you can clearly see is reflected in the numbers as well. But I feel it's a two-sided coin. We're not eating away from your domestic demand into international. In fact, I feel we've never invested as much as we have right now into domestic infrastructure. And that's reflective in airways, airports, planes, roads, highways, state highways, national highways, and so on and so forth, right? So I don't feel that we're eating from each other's pie, but we're adding to both pies together. Last, we'll look at occupancy on the books. And it's always important to have as much of a crystal ball as you can. At the moment, the next couple of months look fine. October and November shaping up quite positively. But December and January look like we're in for a much lower occupancy on the books for the year end as well as the year beginning of 2026. And all of those markets that you see there, right from Calcutta to Hyderabad at the end, are above 10% below what they were last year in terms of occupancy on the books for just the month of December 25 and Jan 26. But that's not to say that everything is bad, because we still see healthy occupancy on the books for leisure destinations. Of course, people like to plan their holidays more than they like to plan conferences or meetings or events like this. So yes, there is a healthy amount of occupancy on the books. Agra at 45% there, and Coimbatore sitting at 13%. This is for the next 90 days. So I'm going to summarize into key points, and this is a lot of data. So if you've not been paying attention, just pay attention to this one slide, and thank you very much. Firstly, there's still growth, but it's just slower compared to what we were in the past 2 or 3 years. And you need to get used to that because we've found a new normal. And now it's sustained but diversified growth from here. Bifurcation that I spoke about, the class of hotels splitting up, is different because in the US, you're starting to see luxury perform higher on rates, but mid-scale economy on occupancy. Here, it's everything pushing together, but it's a trickle-down effect. But variations, of course, exist depending on which market you're looking at. Groups are obviously on an upswing. It's across all days of the week, coming in at higher rates than transient business, so that's positive for the entire country. It's not just leisure and regional that are growing, it's actually the big 3 cities, but leisure and regional destinations have more headroom to grow at the moment. The balance between international outbound versus domestic or inbound is a two-sided coin. I think both pies are growing. It's not like one's eating from the other's food. And lastly, it's important to look ahead and plan. I think we're in for a lower December and a Jan beginning for next year. But that's exactly the kind of data you need to make sure that you're well prepared. Thank you very much. You can scan this QR code and click on BWH IHA 2025 presentation to get the copy of the deck. Thank you.